The Financial Times newspaper recently ran an expose into what they thought was some disgraceful behaviour by MPs. Now, with the current government, not exactly news, but what was it that had the Financial Times so enraged about MPs' behaviour? Was it lockdown parties? Was it the PPE scandal? Was it the highest tax burden in a generation as the NHS and other public services collapse? The trains don't work and you need an off-road vehicle just to navigate the potholes in your road. Nope, it's none of that. The FT scoop was that MPs only invest 2.8% of their money in UK companies, and they thought this was scandalous. In this video, I'm going to explain to you why the MPs might be onto something and it might not be as scandalous as the Financial Times think. And to do that, we're going to talk about something called home bias, which is something that we see all the time where if you're based in the UK, most of your investments are in the UK. And we're going to talk about the pros and the cons of that approach. If you're new here and you would like to get these videos more, hit the like button and the subscribe button. And as course as ever, if you have any questions, drop them in the comments. We'll either answer them there or every so often we do a question and answer episode where we go into a bit more detail because we've been getting amazing questions which can't really be replied to in 2 sentences. So we make a dedicated video for that. Right, let's get into it. So let's start from the basics. You're thinking about investing or you've got some investments and you're wondering what to buy. Maybe you should just keep all your investments in cash. And this is something that I'm hearing a lot at the moment because interest rates are the highest they've been in a generation. And people are thinking, oh, maybe I could just keep all my money in cash. Well, over the long term, keeping your money in cash could be a really expensive mistake. Let me show you why. Here is a nice chart from Vanguard, which shows what would happen if you invested £10,000 in 1998. So if you invested that money in cash, then as you can see, that £10,000 would turn into about £20,000 between 1998 and 2002. Not too bad, eh? But if you look at that yellow line, that is the cash returns adjusted for inflation. And really, returns adjusted for inflation are the only returns that matter. What this demonstrates is that inflation is just eroding the value of your cash so that your cash in 1998, £10,000, now would buy you significantly less products in the real world. £10,000 in cash, 1998, by 2002, in real terms, it doesn't look good, does it? It's probably about £6,000. Cash is not safe. It feels safe because it's sat there in your bank account and the number stays really steady over time. Look how smooth that cash return is over time. There's hardly any ups and downs or what we would call volatility in that line. But it's not really safe over the long term. Long term, cash is losing you money. Contrast that with the light blue line, which is the return of the FTSE All World, which is essentially saying if you bought into every single stock market in the world, the S&P 500, the FTSE in the UK, every market in the world in 1998 with £10,000 and did nothing, what would you have today in real terms? So in real terms, you'd have about £45,000, significantly more than if you'd done cash. But maybe you're sat there thinking the super low interest rates of the last 15 years has not been normal and that's why cash has struggled. Fair enough, but if you were to check out the returns from 1899, so exactly the same experiment but ran from 1899, what do you think you would see? Well, if you go onto the medicsmoney website and you're scrolling down and you say, I want some information on investing, you will see this rather nice graph from Barclays, which shows what would happen if you invested £100 in 1899 into those 3 different asset classes. So equities or shares, gilts are government bonds, and treasury bills is effectively saying cash. So again, it shows a massively favorable performance for equities or shares over the long term and less favorable for cash. So that is why over the long term, historically speaking, shares have massively outperformed cash, and cash feels safe. But actually, once you take into account the inflation, it isn't that safe at all. So then you're like, well, what to buy? Now here you have lots and lots of choices to make. And let's assume that you want to diversify to reduce your risk. And we've talked about diversification in another video, so check that out if you're not sure what diversification is. But essentially it means buying a small amount of many, many things so that overall you end up gaining over the long term. And this kind of strategy was made famous by the founder of Vanguard, who was called Jack Bogle. And his famous phrase is, "Don't look for the needle, just buy the haystack." And what Jack Bogle is saying there is you don't need to worry about picking individual shares. You just buy a little bit of everything by buying a low cost, globally diversified index tracker. And then over time, capitalism and the markets will do their thing. And showed you a chart from 1899 to show you that over the long term, that is exactly what has happened. But what do investors in the UK actually do? What do they actually buy? Well, they actually buy a lot of UK-based companies. Research found that 64% of people with £60,000 in investable assets had more than a quarter of their portfolio in the home market, while 8% had the entirety of their investments in the UK. And that is what we call home bias. So let's just imagine that that is what we did, okay? And between 1999 and 2023, we did that. We had a home bias towards our investments. So this kind of complicated looking chart shows you what would have happened in that time frame. So it compares what's called the MSCI ACWI X UK, which is a really fancy way of saying all of the global stock markets, but without the UK in it. And it compares that to buying the UK stock market, in this case, the FTSE 100. So on the left, we can see that if you had a 0% home bias, i.e. you just bought the MSCI World Index, then you would have returned approximately 7%. On the other hand, if you went all in on the UK and owned 100% of the UK FTSE 100 and none of the World Index, you would have returned about 4 or 5%. So that is a 2% difference for having a UK home bias. But you're looking at those little yellow dots on there and thinking, I wonder what they're all about. Well, they actually make it even worse for those people that had a home bias on their portfolio between 1999 and 2023, because they show the Sharpe ratio, which is a way of comparing the return of the investment with its risk. And in general, the higher that ratio, the better, because you're getting better performance for less risk. And as investors, that's what we're all looking for: lower risk, better performance. So not only did those people that had no home bias and invested in the global stock market, excluding the UK, get about a 2% higher return than those that just bought the home UK market, they also did it with a higher Sharpe ratio, aka less risk. But you're like, okay, Tommy, like that was 1999 to 2023. Maybe things are going to be different going forward, because I've been hearing that the UK stock market is undervalued. What does that mean? Well, let's have a look at this next table, which shows the valuation relative to the earnings of many stock markets around the world. So, quick recap. There's loads of different ways to value a company, and one way, popular way, is the price, which is how much the share of that company costs, to the earnings, which is how much that company earns in a ratio. People have been tracking these over many, many years. So the price to earnings ratio. Slightly more sophisticated than that, possibly, is something called the cyclically adjusted price to earnings ratio, or CAPE, as we can see in this table. And that CAPE ratio is the price to earnings ratio, but cyclically adjusted over the last 10 years using inflation adjusted earnings, which is our preferred way to measure performance. So what this table shows is that whilst the US stock market has a cyclically adjusted price earnings ratio of 28, the UK is languishing just down at 14. And Europe, as you can see, excluding the UK, which is unfortunately the reality that is we are in, is 19, Japan 18, and only the emerging markets with 11 are cheaper than the UK. So this would suggest that at the moment, the UK stock market might be cheap. So we've talked a bit about home bias, and hopefully we understand what that is. We've showed you what would have happened in the past if you had home bias. We've engaged in some crystal ball gazing, which I don't really like to do. But the question is, what do you think? Do you think the UK is cheap? Are you investing more of your money in the UK versus the rest of the world right now? Let me know in the comments. The other question that we need to answer, going back to that stat that 60% of people have a quarter of their investments in the UK, is just what is a reasonable percentage to have in the UK? Well, that's an answer that I can't give you because that would be financial advice. If you think about it logically and your aim is to follow Jack Bogle, then you would try to replicate all of the stock markets of the world in proportion. And if you do that, the UK turns out to be about 4%. Yep, just 4% of global stock markets. And so if you have more than that, like the 60% of people that we mentioned, then you are taking a big bet on the UK outperforming. And if you have less than 4%, like the MPs who've got 2.8%, then you are taking a bet that the rest of the world is going to outperform. So what do you think? Are you more inclined to invest like the MPs who are underweight, investing less of their money in the UK? Or are you like the majority of UK-based investors who are overweight in the UK? For me personally, I don't want to have any kind of bias in my stocks and shares portfolio. So I am just neutral. I'm not overweight or underweight in the UK. I'm just at that 4%. But if you think about it logically, even though I'm not over or underweight in my stocks portfolio, I've got a massive bias to the UK. I have a job which relies on the UK economy, and you've probably got a job that relies on the UK economy as well. So you're all in on the UK. You might own property in the UK, which is another home bias. So I actually think a lot of UK investors have a massive home bias, and how much of that is a problem or not depends on your own risk preferences, tolerances, and goals. But we know what the MPs think, and maybe they're onto something. Let me know in the comments, and as ever, this is not investment advice. Do your own research. Past performance does not reflect future returns. Unless you've got a crystal ball, all you can do is look at past performance. Don't forget to hit the subscribe button and the like button. Hopefully see you on the next video where I'm going to be breaking down JP Morgan's guide to the markets. This is 120 pages of what the best investors in the world think is going to happen. Now, I'm going to break it down into just 5 key pages that are relevant to normal investors like you and me. So if you want to get on that, got to subscribe.